right. Well, the recording is in progress, so it's official. And so I'm Paige Sharp with the Indiana Arts Commission, and I have the honor of introducing our presenter to you, and because she is absolutely fabulous. Been working with Elaine for a really long time. And it is just always so much fun. She really, really, really loves her work, which is always fabulous to be with somebody who loves their work, and she's really good at it. She is a CPA, certified public accountant, which usually I'm just like, oh, and she loves it. It's like her favorite thing, which is amazing probably to all of us creatives on this webinar. So she founded Minerva Financial Arts in 2009 and works to build financial literacy in creative individuals and organizations through education and coaching. Her goal is to make all creative individuals both financially empowered and creatively free. So this evening, I welcome Elaine, who will be walking you through taxes this evening. Take it away, Elaine.
Thank you so much, Paige. Hi, folks. It is my absolute pleasure to be here. I love seeing so many familiar names. And to those of you who I haven't had the pleasure of meeting yet, I cannot wait until we can do this in person. I'm going to go ahead and share my screen so that you can see what I'm seeing. And you should know that I have the chat window open, which means you can plop all of your questions in there as we are going through this to make sure all of your questions are answered. It's a strange tax year. It's probably less strange than last year was, thank goodness, but these are strange, interesting, and delightful times. And there are a couple of key things I want to make sure you know about as we're going into this tax season. As Paige mentioned, I'm Elaine. I use she, her pronouns, and I am joining you from Dublin, Ohio this evening, which is Kashkashkia and Hopewell Indigenous and Cultural Lands. And I am a CPA with a personal financial specialist designation and an accredited financial counselor. And all of that collection of letters means is that we can talk about taxes and retirement and investing and budgeting, which sometimes connects with taxes as well. And then the counseling part means I can hand you tissues while we cry about all of that together, because all of those things are really, really hard in the arts. And in addition to the amazing Indiana Arts Council, which as Paige said, I have been working with for quite some time, I have the pleasure of working with a ton of other amazing organizations that give generous funding to artists and arts organizations across the country, including some other arts councils and commissions, and then also a handful of educational institutions, because I would love for any student who's pursuing a career in the arts to have all this financial stuff mastered as they enter that career. As we are going through everything tonight, we want to make sure you feel like you can both take space for yourself to make sure your questions are answered and make space for others as well. That's why we've got the chat. You can also use your icon if you want to raise your hand or wave if you're on video to get my attention. We are also all equal parts teachers and learners, which means you get to take this information and decide how it works best in your practice. That will become particularly effective when we talk about record keeping systems at the end, because depending on how you like to work and what your priorities are, different systems might be a better match for you. And then, of course, although this is being recorded, we do want to make sure that stories that might be shared stay here within the space, although by all means, take the lessons from those stories and carry those with you. So what we're doing is talking about taxes, but more specifically, we want to highlight the federal tax landscape in general, including some new things you want to make sure to pay attention to. We will talk about common creative deductions that are probably showing up on your tax returns, and then we'll conclude by talking about some record-keeping systems. And of course, all of this information is for educational purposes only. So if we were to start with sort of this idea of federal income taxes, they basically are governed in part by Form 1040. This is the main form that individuals in the United States file. And it starts with some human information like your name and your address and your filing status. And then we get into the money part. And the first kind of big question you have to answer, which is surprisingly challenging to answer sometimes, is how you earn money. And we know in the arts, it is very common to have income from a lot of different sources, right? For better or worse, that is part of our reality as arts professionals, which means it's up to you to figure out where that different income gets reported on your tax return. So if you have maybe what we would call a day job, or if you work as an employee for someone else, you are paid as what we call a W-2 employee. And all that means is that your employer is withholding taxes from each paycheck. And then at the end of the year, they send you a W-2, right? And that tells you how much they paid you and how much they withheld for different tax purposes. The big thing to know about W-2 income is that you cannot take any deductions associated with that income. A lot of people were really upset about that when we were all working from home, right? And maybe you had to buy an extra computer charger or a ring light in your home so that everything looked glorious on all these Zoom calls, right? If you are a W-2 employee, even though you are buying those things for your work, you don't get any deductions. Now, if you are self-employed or running your own business or freelancing or gigging, anything else, right? Then you report that income probably on Schedule C if you're running a business, and you are generally allowed to deduct ordinary and necessary business expenses that you incur as you are earning that income. Right? So that's the huge difference here. W-2 income, no deductions. Contractor, freelance, gig income, all of the deductions, as long as they're ordinary and necessary, right? So this might look like grants you receive or awards or other income that is sort of awarded to you in the course of your business. It might look like 1099s you collect at the end of the year. You might have a big stack of them right now. Generally, companies are supposed to get them to you by January 31st, but I know I still have a couple trickling in because companies are run by humans too, and that's okay. So anytime a company pays you more than $600, they will send you a 1099. All of that income generally gets reported on your Schedule C because it's self-employment income or freelance income or gig income, whatever you want to sort of call it. It's also possible you have income from sales, maybe of your work, maybe of merchandise, maybe of prints, maybe even of downloads of music you might have made available to the public, right? Any of that income that comes from sort of the sale of your work, that income also gets reported on Schedule C. Now, your clients won't necessarily send you a 1099 for that, right? If I am purchasing a painting from someone, right, the painter or the artist isn't going, or I'm not going to send them a 1099 at the end of the year. I'm just their customer, right? So it's up to you to track the income from any sales you might have. And all of those different types of income, as long as they're related to the creative business you are running, which is pretty broadly defined, gets reported on Schedule C. And this is what the top of Schedule C looks like. Schedule C shows the profit or loss, because you're allowed to have those, from your business. And then you'll see underneath here, it says sole proprietorship. That means one person doing business for themselves. So if you are a sole proprietor, you use Schedule C. Or if you are the only owner of your LLC, your limited liability company, you will also use Schedule C, because for tax purposes, that is treated just like a sole proprietorship. Now, if you're a musician or you're a filmmaker and you have an LLC that you own with other people, then you're probably looking at Schedule E here instead of Schedule C. Basically, the same things are deductible, but it's a slightly different form and it's slightly more complex. You'll also notice here that I have circled box B, and box B says enter code from instructions. That's where you report to the IRS your standard industry classification number, which basically tells the IRS the type of business you are running. For independent artists, writers, and performers, which is a very broad category, the code is 711510. So that is often the code for many of the individuals I work with. If you're a photographer or if you are doing design-specific services, you might have a slightly different code. But in general, independent artist, writer, and performer, 711510, covers a whole lot of individuals. So you notice probably at the top of Schedule C, it says profit or loss from business. And sometimes that word business kind of bothers people, right? Because they say, am I really running a business, right? And that does not mean you have to incorporate or form an LLC or do any number of other things. But the IRS does have some pretty specific things it looks at to see if you are running a business. And the reason the IRS looks at this is because, as a general rule in the United States, personal expenses are not deductible, right? So if I want to take up a hobby of playing the flute and I want to start paying for flute lessons or purchasing an instrument, as a general rule, those personal expenses are not deductible to me. But if I were a professional flautist, there's a totally different story. All of those expenses would be deductible, right? So this question of, is it a personal expense or is it a business expense, is one that's really interesting to the IRS. So that's why they care whether or not you are explicitly running a business. So what that means to the IRS is you are running a business if you approach this thing that you're doing, we call it an activity, professionally, and if you keep books and records. Books and records are a really good way to show that you are, in fact, running a business. This is tracking income and expenses, or maybe keeping track of customers or clients. Maybe you even have a business plan. You don't have to, but anytime you're keeping track of those sorts of things, that suggests you are pursuing it professionally as opposed to as a hobby, right? So that's the first thing the IRS would look to. And I will tell you, the IRS loves income and expense tracking, right? So if there were one thing you could do to kind of improve maybe some habits, I'd give some attention there to make sure your books and records are in really good shape. The IRS also wants to know if you spend enough time on the activity to make it profitable. This is this idea of regularly carrying on an activity, right? As opposed to doing it maybe once or twice, right? I was working with someone not too long ago who had a really great example of what this might look like. This person had a full-time job and she was interested in maintaining her full-time job, which had nothing to do with the arts, until her daughter graduated high school. There were health insurance reasons for that and retirement contribution reasons for that, lots of other reasons, right? Plus, she kind of liked the job. It gave her a lot of stability, even though it wasn't arts related. And twice a year, she would participate in mural painting projects and receive income for that. We had a really interesting conversation around whether or not twice a year was enough to consider herself regularly carrying on an activity. And the answer is probably not. If all she was doing was one mural in the spring and one in the fall, that's probably not. Now, does it have to be every day? Definitely not. But we would look to see if you are regularly carrying on the activity. We also look to see if you're making money from it, right? The more money you make from it, the more likely it is a business as opposed to a hobby, but you don't have to be making money from it because, as we know, that is not always an easy thing to do in the arts. And then lastly, the IRS wants to know if you have the knowledge needed to make it successful, right? Me picking up an instrument for the first time would not have the knowledge needed to make my professional pursuit of that successful. But you, having built a career, cultivated relationships, developed marketing strategies, built a body of work, attended educational sessions like this one, all of those things suggest you do have the knowledge needed to make this successful. There's a great question from Matt in the chat. Matt says that Matt read on a website that Schedule C doesn't have to be filed for a no income year. For example, the LLC was started in December. Is that what you would advise? Probably, if you started it in December, I think you're fine because you probably wouldn't have any income. You may want to, if you had expenses and you wanted to count that as your first year. So let's pretend you had a, $125 formation fee for the LLC and you spent, $800 to build a website and buy a domain name. In that case, it might be worthwhile to you to claim those expenses so that you could at least have the deduction for them. However, that's going to give you a loss in your first year, which is fine, but it's just something to keep in mind. So if you had no income and you kind of think the expenses are de minimis and you don't want to worry about them, I think that is perfectly fine. Great question, Matt. And speaking of having losses in a year, you may have heard that the IRS has what they call a rebuttable presumption, which means they will basically assume that you are not running a business unless you show profit, meaning your income is higher than your expenses, in 3 out of every 5 years, right? So in Matt's example, let's pretend Matt does file Schedule C to report expenses with no income. Matt is not showing a profit in year 1, which means in the next 4 years, at least 2 of those years would have to show income in order to satisfy this rebuttable presumption, which is kind of annoying, right? And I will say the word rebuttable is a really good one in here, because although this is the IRS's sort of working assumption, you can absolutely provide evidence of any of these things to show that you were in fact running a business. Now, I don't have a lot of insight into what the IRS is thinking, but it would not surprise me if they relax this a little bit, having gone through now our 3rd year of a pandemic, right? Because for many individuals, particularly those in performing arts, but in lots of other fields as well, it was really challenging to show income during 2020, and even challenging in many ways to show income during 2021 as well. So I would not lose sleep over this rebuttable presumption, particularly if you feel confident about meeting this criteria. So let's pretend you are in fact running a business and you feel really, really good about that. The next question then becomes, what expenses are deductible in my business? And if you have not watched the exchange between David Rose and his father in Schitt's Creek season 2, episode 6, I would highly recommend it, because they talk a lot about deductions for the blouse barn where David was working at the time. None of what they say is accurate, but it is absolutely hilarious. And I love anytime deductions are discussed in pop culture. So the accurate take on deductions, or a deductible expense, right, is that an expense is deductible if you are permitted to use it to reduce your taxable income. That's it. So you have income from whatever you're doing, selling work, teaching workshops, performing, maybe teaching clients or taking on students, right? Whatever you're doing, income related to your creativity is your income number. Then you have deductible expenses that reduce that income, and effectively you pay taxes on the net amount, because you are permitted to reduce your taxable income by those expenses that you need to incur to run your business successfully. But there's some gray areas in those words I just said, right? To run your business successfully. What does that mean? Luckily, the IRS tells us. The IRS says, in general, expenses are deductible if they are ordinary and necessary and effectively connected to your trade or business. So the IRS defines ordinary as common and accepted in your industry. And remember, at the top of Schedule C, you told the IRS what industry you were operating in, which means the IRS has lots and lots of algorithm-based data about others who are reporting in that industry to sort of identify what is in fact common and accepted in that industry, right? If you have something that feels like it's a big outlier, it might raise some scrutiny from the IRS. And that's okay, as long as you feel like it is ordinary and necessary, right? And as long as you can explain it. The necessary piece means the expense is helpful and appropriate for your trade or business. And here's where, in those books and records, particularly the records related to your expenses, we definitely want to make sure there's a moment in there where you are explaining how the expense is helpful and appropriate, because the IRS might not necessarily know what is helpful and appropriate for your business, because the IRS is not necessarily in the business of being artists. The third piece is that effectively connected to your trade or business, which means it has to be related, right? So this is something that comes up particularly when the expense feels like it could be personal, or when it's not really clear that it's a business expense. So let's pretend after this workshop, Paige and I decide to go out to dinner together. And even though she's a government employee, I'm going to go ahead and buy her dinner. She would never let me do that, but let's just say she would, right? So I buy us dinner. Let's say it's $50. I would write on my receipt, dinner with Paige to talk about next IAC webinar opportunity. That is demonstrating that this meal had a business purpose, making it effectively connected to my trade or business of giving webinars to various state arts councils and commissions, right? So that sort of documentation is wonderful to have to support the fact that the expense is effectively connected. The other time that becomes important is when it's an expense for research, or maybe attending an event, or something that feels maybe a little squishier. It's a technical tax term, right? But if it's not obvious that it is supplies for your artwork, right? Or website fee or something like that. If it's something that feels like it needs some explanation to show how it is effectively connected to your business, that's a good thing to go ahead and provide. And I will note, although this is a general rule, there are special rules around a lot of these things, and we'll talk about that as well. But in general, if you're struggling with whether or not something is deductible, go back to ordinary, necessary, and effectively connected to your trade or business. Because if you can say, yeah, this is common and accepted, and it is helpful and appropriate, and here's how it connects to my business, then you have a pretty solid argument. This is what more of Schedule C looks like. This is the expense section, and you can see there are a lot of different categories here, some of which might make perfect sense for your business, and some of which you might never use. I will also draw your attention to this line 27A, way down here at the bottom. Line 27A says other expenses from line 48. And this is why tax forms drive normal humans crazy, right? Because they often refer to other places and you have to flip the pages or the PDFs around, and it's really frustrating. This is basically what line 48 looks like. It's a big blank section. And I've shown you, I think, 4 lines, but it usually has, 10, 12, 15 lines here. If you have an expense category that doesn't really fit well in any of these other categories, you get to name your own category in this section, and that is perfectly fine to do. Best case scenario, you find a category where it really fits based on the description, but there are lots of things that you will have that will not fit well in these categories. So don't be afraid to name your own categories. I would say just keep track of the names you're using from year to year so that you can report consistently, right? We don't want to sort of move expenses around into different categories. We want it to generally be consistent from year to year. So now we can move into one of my favorite games to play. Hey, Elaine, is it deductible? And so I've pulled out a couple of common creative deductions that may be showing up on your tax return to talk about. And then we'll have some time, if there are other deductions that I didn't mention, please, please, please bring them up so that we can talk about them together. First one is supplies you use in your studio practice or in your musical practice or performing practice. Do we think these are deductible? You can vote in the chat, or you can use an icon or a thumbs up. What do you think? Yep, couple thumbs up, couple thumbs up. Some people abstaining from the vote, which is totally fine. Yes. Supplies you're using in your studio as a general rule are deductible. But Portrait Johnny is pointing out that there is a little tweak to this, which is the timing of the deduction sometimes matters, right? If you are, let's say you're a photographer, or you're a digital artist that might occasionally make prints, but in general, that's a really small part of what you do. In those cases, tracking the cost of each piece of paper and deducting it when you sell a print or a photograph might be more work than it makes sense for any human to do, right? So if we consider that your expenses for your supplies are basically used in bulk, or it doesn't make sense to track them or associate them with a particular piece, then your advisor or some advisors would recommend deducting them all on the materials and supplies line, right? If you are a crafter, or if you are a fine artist, or if it's a little bit easier to identify the materials that go into the thing you're selling, then those are all still deductible, but you're supposed to wait until you sell the thing before you deduct those costs, right? And generally this shows up on line 4 and then also line 22 on your tax return. And the reason it's in 2 places is because there's a section on the back of Schedule C that helps you calculate this, right? And the way the formula generally works is you start with what you have in your inventory. So finished goods, works in process, plus your materials at the beginning of the year. Then you add in all the purchases you made during the year, all of those receipts from all of those vendors. And then you subtract whatever is left at the end of the year. And the difference, or whatever your remaining amount is ultimately your cost of goods, right? So that's how we would sort of back into it if you are not clearly identifying, the costs that are directly going into one piece. Sue shares in the chat, if I spend $40 on framing and printing, but sell it $100, when I fill out the online state tax info, would I say I made $60 for tax purposes? Yes, although depending on the state tax info you're talking about, if you're talking about sales tax, so maybe you're collecting sales tax on that sale, the way the reporting usually works is you report the gross amount. So for sales tax, you would say the sale was $100, you collected $7 and however many cents, and then you would send that sales tax to the state. If you're talking about income taxes, then for your state tax return and also your federal tax return, you start with the $100 number and then you show that the deduction is $40, so that ultimately that taxable income number becomes $60. So for federal tax purposes, the IRS wants you to show that detail as opposed to just reporting $60 of sales. This also comes up, by the way, if you are accepting payments through, say, Venmo or Cash App, or some of the other services that deduct a fee from the top amount. The right or best way to do it is to report the total amount and then report the fee as an expense. Sometimes people don't do that because it's a lot of work, but that is sort of the best practice in terms of reporting. Great question, Sue. How about hardware or equipment? Think like cell phone or a computer. If you're an illustrator, maybe a Cintiq, maybe an iPad, maybe you have a loom or a big sewing machine or a kiln. What do we think? Are those types of things deductible? Portrait Johnny says yes. Couple thumbs up. Yep, I like it. As a general rule, yes. We want to make sure we're documenting the business purpose of the hardware or equipment, of course. And if there is personal use, we want to make sure we are what they call bifurcating that, which basically means carving out or not deducting the personal use piece. And that comes up especially for cell phones and computers. If you have a Cintiq or you have a computer that you only use for your business, right, you can deduct the whole thing. That's totally fine. But your cell phone probably has some business and some personal use. And what many people do is maybe use one of those screen tracking apps, or maybe they'll document kind of what they're doing on their cell phone to figure out what percentage is business use. Maybe it's 70%, maybe it's 80%, right? Whatever percentage feels like it reflects your use of the cell phone, that's what you can generally deduct of the cost when you purchase the cell phone and also of your monthly bill. And then I'll also note, if you are paying for insurance on any of that hardware or equipment, that insurance is probably deductible as well. How about professional support? Your accountant, your attorney, maybe someone if you're a musician, maybe you are paying to take a masterclass lesson from someone. What do we think? Is that deductible? Yep. Lots of thumbs up. A celebration emoji, that's even better. Yeah, that's all deductible, right? Make sure that the professional support is for your current industry, not a new industry, right? That's why tuition is not deductible as a business expense, but definitely save your receipts, and this is generally speaking deductible. Matt says, could I possibly lease or rent my phone to my business at some reasonable rate? You probably could. So let's say, so there are kind of two ways to do this, Matt. One way would be for you to pay for your phone out of your personal bank account, and then just make an adjustment at the end of the year that basically says, okay, I spent $100 a month on my phone, that's $1,200. And let's say it was used 90% for business purposes. 1,200 minus that 10% of $120 is, I'm not great with the mental math, but I think it's $1,090-ish. You can check my math on that. But then you would basically use that to just claim the deduction on your Schedule C. And you're basically saying it's an allocation of business use of the asset. The other thing you could do is basically do the same thing, except every single month, you would then almost like reimburse yourself for business use of the phone. And that would be totally fine to do as well. The first way is probably a little bit easier. The second way leaves a little bit of a better paper trail. So it might depend on cash flow and kind of what makes sense for you. Great question. Software and subscriptions, as a general rule, these are deductible. We want to make sure we're documenting the business purpose, of course, and this is a good moment to make sure you are backing everything up regularly. So let's say you use a business expense tracking software. Maybe it's something like QuickBooks or Xero or Wave. Or maybe you use Constant Contact or MailChimp or another software platform to communicate with your clients and customers. Every once in a while, maybe like once a year for those kind of things, more often for maybe other types of services, let's go ahead and back up those client lists and all that sort of information from your systems, just to make sure it exists in case something crazy were to happen, right? The same is true for maybe you use Mile IQ, for example. That's a great app to track your business miles driven. I don't believe you have to pay for it, although there may be a sort of 99-cent initial download, but you would want to make sure the data gets off of Mile IQ in some place where you can save it in case the app doesn't exist by the time the IRS gets around to auditing you, right? So just file that away. If you're using extra storage or external hard drives or cloud backup systems, all of that stuff is generally deductible as well. How about professional attire? You all look lovely this evening, like you're wearing your most professional artist attire to attend this workshop. Is that deductible because you're wearing it to a professional engagement? I'm seeing some mixed responses. Couple thumbs up, couple of shaking heads. Generally, no. I'm sorry. I wish it were. The IRS's general rule is that if it is something you could wear somewhere else, it is not deductible, right? Now, this is an area where people can get pretty aggressive, right? And it depends on kind of your comfort level and how good you feel about ordinary, necessary, and effectively connected to your trade or business, right? But in general, if you are a performer, It has to very clearly be an over-the-top costume piece to be deductible, as opposed to attire you could wear anywhere else. Performance shoes are generally deductible because we don't generally wear those outside. Safety equipment, generally deductible. Reference materials. I had an individual that was doing an entire illustration series around Marie Antoinette and needed to purchase a lot of corsets. So they purchased a bunch of corsets and used them as reference material, right? I would not call that attire. I would call it reference material, right? Because then it makes it very clear that it is deductible. Sarah shares in the chat, not deductible because there's a day job uniform. Yeah, that's exactly right. And that's another good example, Sarah, around how anything you have to pay for your W-2 job is not deductible, which is supremely annoying, right? So, if it's a uniform you have to purchase, even if they give you a discount, not deductible. Or maybe you work in, say, a salon, or maybe you have a part-time job at a gallery and they say, we want you to wear black attire head to toe. Also not deductible because you could wear it somewhere else and you're a W-2 employee. Research is a category I absolutely love, but this is another category where you can sort of be as aggressive or as not aggressive as you're comfortable with. If you are deducting research, please make sure you are documenting the business purpose of the research really well, because this is an area that people tend to abuse. Your best case scenario is that the research supports your body of work or a project you are doing, or something that feels like it's really related to your practice. Common things I see in this category, which by the way is one of these line 27 items. So this is usually a category you define yourself, but very often this might include tickets to a special exhibition at an art museum that you are paying for out of pocket. Or maybe it is, let's see, maybe you're a performer and you are going to see a particular theater piece because you are especially curious about the director's work and you might be working with them down the road. Maybe even you are a photographer and you are exploring different places, or maybe a better example, maybe you're a painter and you're exploring different places, taking reference photos and bringing them back to your studio. All of that kind of falls under this research umbrella. But as I mentioned, it's easy to abuse. I was working with a writer once, a playwright, who happened to love the Yankees, and he had season tickets to the Yankees every year. He went to almost every single home baseball game that they played. And he told me that he had always dreamed about writing a play about the Yankees. And he said, can I deduct my season tickets? And I said, I love the way you think, but that feels really aggressive, right? Because this wasn't really research. It was something he might do later, and it was something he really loved and had been doing since before he was a playwright, right? Best case scenario, someone commissions him to write a play about the Yankees. He attends 4 or 5 games, sitting in different places around the stadium, taking notes, taking reference photos, incorporating what he learns into the dialogue of the play. In that scenario, yeah, I think you can legitimately say tickets to those 4 Yankee games was research. But there's a big difference between season tickets year after year after year and a couple of games to support a commissioned project. Office supplies are deductible. That is not very controversial at all. I like documenting the business purpose just because, but these would be pens, pencils, notebooks, journals you keep, kind of whatever you need around your office or studio. Now that probably also includes lots of hand sanitizer, maybe extra disposable masks that you are purchasing for people that might come through, maybe extra cleaning products, right? Those types of things all fall within this category. Marketing materials are also generally deductible, and this is not very controversial either. Maybe you have an artist talk coming up and you do some paid promotions on social media. That expense would be deductible. Or maybe you hire someone to design a show card for something you have coming up, right? You have a bunch printed and then you leave them at coffee shops all over town. All of that is marketing or advertising. And generally speaking, it's deductible. Now we can talk about really, really good one, which is home office or studio space. And I won't even ask you to vote because we know it's deductible, but we know there are some very, very specific rules around it. So here are those very specific rules. You have to make sure you are complying with these rules really, really well, right? Because the IRS knows this is an area where people don't always understand the rules, and sometimes they push the rules a little bit. So the IRS knows this is an area that they can scrutinize very effectively. And you'll also note this shows up on line 31. That is well below all of the other business expenses we've been talking about. So the way Schedule C is set up, it shows your income, then your expenses, then there are a couple subtotals, and then there's the home office line. Business use of your home is what they call it, right? So it hangs out all by itself on line 31. This is not something you can bury on another line. And the rule says you have to use the space exclusively and regularly for your business purpose. It has to be your principal place of business, and you cannot have any other space where you conduct administrative tasks related to your business. So what I would do is, if this is something that makes sense to you, identify the space that you use exclusively and regularly for your business purpose. Maybe it is a room, maybe it is a separate like outbuilding, maybe it's a garage or a basement, right? Maybe it's a section of your living room or dining room, right? Wherever it is, identify the space and then measure out how much of that space it is, usually in square feet. Then we estimate the total square feet in your home, divide the business use over the total, and then you get your business use percentage. Then you can take that percentage and multiply it by your rent or your mortgage payment, your utilities, your Wi-Fi, homeowners insurance possibly falls under there. There was a great case where somebody wanted to include like their homeowners association fees. So they took a percentage of those as a business expense, right? So it gets to be pretty substantial pretty quickly, depending on where you live, right? So this is one that could be good, but we want to make sure that the space really is exclusively and regularly used for your business purpose. The next thing I would do after we've done the calculation, I'd probably draw up a little floor plan, and I would probably take some photographs or maybe a video of the space when it's looking its absolute most professional. And I would just hang on to that in a tax file so that if you move or if there are ever questions raised, you have some documentation to share with the IRS agents. I will also refer you to publication 583 from the IRS. They have an entire section devoted to business use of your home. And they have a lot of examples in there and a really great write-up. Do we have questions on this expense? This sometimes is a challenging one. Looks like you're feeling good. Travel, meals, and lodging. As a general rule, these are all deductible, and we call it travel if you are spending a time away, a night, if there's an overnight stay away from sort of your tax home, right? So travel, meals, and lodging means there's an overnight stay. You might sort of drive around and have some sort of local travel. We don't call that travel. That's sort of a car or automobile expense on line 9. But if you are away from home with an overnight stay, we call it travel. And the rule is you have to have the primary purpose of the trip be business related, right? So it can't be flying to attend your best friend's wedding and then seeing a gallery show while you're there and deducting the whole trip, right? The primary purpose of what you're doing has to be business related. I will also note that In normal times, you can only deduct half of your meals, right? That's just an arbitrary, random rule that has existed practically since the beginning of tax time, with a handful of exceptions. Right now, for 2021 and for 2022, as a bit of support to our friends in the hospitality industry, meals while you are traveling are 100% deductible. So that means last year, if you happened to travel to participate in a festival, and so maybe you leave your home on Thursday, you set up on Friday and have an opening Friday, you sell all day Saturday and half the day Sunday, then you come back. Any of those meals while you're in travel status are 100% deductible instead of 50% deductible, which is a really good thing. And I will note that continues through the rest of this calendar year as well. I haven't seen any activity around extending it beyond that, but we will certainly keep you posted. Now I'm going to go back a little bit because Sarah asked about point 3 under home office. And I'm curious, Sarah, what point 3 is. Is this principal place of business where, and you say everyone works from home at times. Is that your question, the principal place of business piece? Excellent. Okay. So this is where we want to make sure we're only thinking about your self-employment activities, right? So if you are an employee of someone else, you are absolutely right. Everybody does work from home sometimes. That does not count. Because remember, if you're an employee, there are no deductions. But if you have your main studio space in your home, then that would make it your principal place of business. But maybe your main studio space is in your home and you rent out a space in another, like a warehouse location where a lot of artists have really cool studios. All of a sudden, then your home is no longer your principal place of business. But what if you don't rent out another studio space, but you rent out, let's see, a storage space, for example, or, occasionally you go and work at a coffee shop or something like that. Or you're saying an external office space. If you have an external office space that you are paying for, you cannot then deduct anything in your home, right? Because then the external space is by default determined to be your principal place of business. And I'm sorry about that because that's really annoying. And for some people, depending on kind of the type of work you do and your needs, for some people, that's enough to say, you know what, I don't want to have a co-working space or, anywhere else. I'm going to keep everything I need in my home. I hope that helps. If you have more questions, we can catch up more on this. Business miles driven is another good deduction. This is one where as you are out and about around town, meeting with gallerists or visiting your accountant to drop off all your tax information, right? All of those miles driven in your personal vehicle are deductible. And the general way we track this is to track the miles. I mentioned Mile IQ being an app that a lot of people use to track them. You can also use a notebook in your car, or if you have QuickBooks works as well. Or if you like Google Sheets or Excel, you can just track the business trips in that sort of document, which is perfectly fine. But we do want to have some sort of written, I should air quote that because it can be in an app, you just have to be able to get it in tangible form. So some sort of written documentation of the miles, we multiply that by the standard rate. For last year, it was 56 cents. For 2022, it is 58.5 cents. And that's how you calculate the deduction for business use of your car, which does not have to be exclusive or regular, unlike home office or home studio. Business meals might come up, as in the example I mentioned with Paige earlier, right? Where you're having a meal with someone and discussing something relevant to your business. This year and last year, those are also 100% deductible, which is another really good thing. The meals do have to be in a restaurant, right? So file that away, but that could be an incentive for you to take a meal at a meeting instead of not, or take a meal at a meeting, take a meeting at a meal instead of not. So file that away for this year. Professional memberships are also generally deductible. This is not particularly controversial if you are a member of an art league or you have some sort of professional affiliation. Maybe you're a writer and you're a member of the Dramatists Guild or something like that. That is generally deductible as well. Just look for a note on the receipt that says how much, if any, might be spent on lobbying, because that part is not deductible. What other expenses are you curious about that we didn't talk about? Portrait Johnny says work for a 501c3. When you say work for a 501c3, do you mean work you're donating to an organization, or do you mean like a W-2 job you have from that organization? Unpaid donated time. I was right there with you until you said time. Time is not deductible. I'm very, very sorry. So if you volunteer your time because you are a wonderful person, even if it is your professional time, that is not deductible. If you are donating goods, so let's say you donate, what is your discipline, Johnny? Are you a portrait artist, dare I guess, from your name? Yes, okay. So let's pretend you attend the Humane Society's annual gala and you offer to paint portraits of adorable dogs for adoption, and you're there for like 6 hours, right? None of that 6 hours is deductible to you, but paints you use, canvases, transportation to and from the event, right? Maybe you print off some extra show cards while you're there to hand out to people. All of those are deductible expenses, but your time is not. I'm sorry. Speaking of contributions to charities, on this adjustments line, there is an extra deduction for 2021 for contributions to charity. The contribution has to be what they call a cash donation. So it has to be money. It cannot be used clothing you're donating to a thrift store or something like that. And it has to be to a qualified 501c3 organization. But you can deduct up to $300 per person on your tax return. So if you are filing as a single individual, you get up to $300. If you are filing jointly with your spouse, you each get $300 for a charitable contribution of $600 for the year, even if you take the standard deduction instead of itemizing, which is really, really good. Paige asks about the donated portraits of the dog. Great question. You can only deduct the cost of those portraits. So let's pretend if I were to commission Johnny to make a portrait, Johnny might say, yes, I would love to do a portrait of your dog. That'll be $5,000. And I say, great. And we sign a contract, and then, I pay a deposit, and then I pay the balance at the end. Even though the fair value of that portrait work is substantially higher than the costs of the paint and the canvas, right? It's only the costs that count as a deduction, making it very tough to donate your work. Still a good thing. But I would say if you do find yourself feeling moved to donate your work and knowing that you're only going to get a deduction for the costs, maybe you make an effort to get extra value out of that. So let's say, I'm going to change the facts. Let's pretend Portrait Johnny donates an amazing piece to like a botanical garden auction or something. And the botanical garden does a silent auction, and Johnny's piece ends up going to the highest bidder for $18,000. If I were Johnny, I might say, you know what? I would really like to have a list of everyone who bid on my piece that didn't get it. That way I could follow up with them. I could say, thank you so much for bidding on my piece. It means the world to me. I'm so sorry you didn't get it. Would you like to see some of my other work? Or would you like to do a studio visit, right? Somehow attempting to get more value out of it other than the deduction. Not a guarantee, but it might help. Victoria says, Victoria has a question about grants. If you receive a $2,000 grant and 300 of that was payment for time and everything else was materials, am I just responsible for reporting the 300 income, or do I need to itemize the full 2,000, the full amount, right? And the way that would work is you would report your grant income of $2,000, and then you would report the expenses of $1,700 in whatever categories they were. Maybe it's materials or hiring a bookkeeper, whatever it is, right? And then what effectively happens is the taxable amount is that $300 that's left at the end. But you do need to report the full amount, because you'll probably be getting a 1099 that says the funder gave you $2,000 or awarded you $2,000. So you want to make sure what you show on your tax return matches what the IRS thinks you should show on your tax return. Sue says, Sue's going to a photography workshop in Montana and driving, amazing. And oh, your husband and your baby are coming. That sounds so fun. You're making it a 2 to 3 day stops to and from the workshop. And let's see, you're a nature photographer, you're going to be using the time. Totally agree, totally agree. Is any of the road trip deductible? I would say all of it is deductible. You know, I think the primary purpose of the trip is very clearly business related because of the workshop, right? That is the primary purpose of the trip. I would make sure your notes say that in your tax files. And I would say your share of the meals are deductible, right? Because you're going on the trip, primary purpose is for business purposes. I think your husband and daughter's share of the meals are not deductible, but I'm assuming you're all going to be in the same hotel room, so that's probably deductible. And if you were to say, spend, you know, extra time that was totally vacation, right? Not to and from the workshop. So let's say you're like, I'm in Montana, I'm so close, I'm going to go ahead and see the Badlands of South Dakota while I'm here, right? If you do sort of an extra little bit that feels like a family vacation, I would carve that out. But I could also see you saying, I would do that anyway because I'm a nature photographer and I would really love to photograph the Badlands. So I think there's probably a way to deduct the whole thing, not their meals, but your meals and everything else, and not really worry about it. I hope that's helpful. Good question. The other thing I want to draw your attention to on Schedule 1 is that you can contribute to retirement accounts, either an IRA up to $6,000, or if you want to contribute more than that, as someone who is self-employed, you can open up a SEP or a solo 401k or some other more complex plans. We did a webinar on this at the end of last calendar year that is archived and on the IAC's website if you want to visit it and learn more. So file that away and know there are some tax benefits there as well. What I want to leave you with is some ideas for record keeping as you are thinking about this. And my main piece of advice here is, as you are preparing your taxes from 2021, pay attention to any pain points you have. Like, oh my gosh, it's so annoying to find my cell phone bills from the whole year, or gosh, I really wish I had tracked those miles, right? Whatever those pain points are, incorporate them into your system going forward so that next year will be more pleasant. And your system should capture the date of every transaction, the counterparty, so who did you pay or who paid you, the amount of the transaction, and I would say most importantly, the business purpose, right? Your receipt, a credit card statement, a bank statement, those documents will capture all of this information automatically. This business purpose is what you need to proactively provide as part of those books and records you are keeping. And the IRS says you can use any system suited to your needs as long as it shows money in and money out. Here are some examples of systems that some people love. YNAB, Personal Capital, and Mint tend to be personal in nature, although I do have a lot of people who will set up a separate Mint username for their business and maybe link it to their business account, separate from, say, any personal use of Mint they might have. And that's great. You'll probably have to do some work defining the categories because the algorithm is good, but not fabulous. But that's a really good option if you like a system like Mint. QuickBooks is sort of the classic standard, but it's not super user-friendly, nor is it super cheap. Wave is one that people really, really love, like to an irrational degree. So if you're looking for a system, Wave could be a good one you might want to check out. And then you can always just use Excel or Google Sheets or Numbers, or even your existing bank system, right? Because whoever you bank with, whether it's a huge bank or a local or regional bank or a credit union, most financial institutions have built in some analysis tools into their online websites that will automatically categorize expenses for you and maybe even help you with some projections. They also usually have some sort of field where you can add your own business purpose as well. That's where I will go ahead and conclude it. We are exactly at time. I will be happy to answer any additional questions you might have, and also happy to wish you a lovely evening, and encourage you to file your taxes when it feels like a good time to do that, and dust off those record-keeping good habits from last year and keep them strong this year. Paige, Connie, did I miss any questions? Oh, Portrait Johnny says, as a sole proprietor, what's the recommendation for documenting paying yourself? Great question. You cannot deduct the payments to yourself, but that's okay. What we generally do is show transfers to yourself. So let's pretend you sell one of those pet portraits for, let's say $10,000, because it's going to make my math a little bit easier. Maybe you say, I'm going to set aside 30% of that $10,000 for taxes because I know I'll probably have to pay them. And I'd like to reinvest 20% in my business. That might mean you deposit the check or take the payment into your business account, leave $5,000 there, and then transfer $5,000 to your personal account. That's how you would essentially pay yourself. But in sole proprietor or LLC world, it's not a salary and it's not deductible. We just call it a member draw or an owner draw, because it's essentially just moving money from your business pocket to your personal pocket, all sort of on the same beam. But that's a good way to do it. If your practice is robust enough that you feel like you can start paying yourself, say, a set amount on a monthly basis, that's a good way to do it as well. I have some clients that do it every time they're paid, they're transferring a little bit to themselves, and then others reinvest everything in the business because that's the stage they're at. And if your business is substantial, so let's say you're, $125,000 in revenue or up, at that point, we should talk about making you an S corporation, because then you really can pay yourself a salary that is deductible. And there's some really fun, although complicated and expensive tax things you can do at those levels. Heather says, how does the taxation work on that draw from projects? Do we pay tax the full price on the business and on the draw to our personal accounts? No, the only because see, moving money from business to personal and vice versa, those are not taxable events. Thank goodness, right? So you would report the income from the project on your Schedule C, and then all of the expenses, and then what you pay, not counting payments to yourself, because that's not a real expense. And then what you will ultimately pay taxes on is that net amount. And you pay taxes on that through your personal income tax return, right? But withdrawing money or transferring it to your own personal account, not taxable at all. I hope that helps. It's a weird kind of illogical thing, but we do that a lot in tax world. Victoria says, Victoria paid an assistant $245. You do not need to 1099 them, Victoria. You are exactly correct, because your obligation to a contractor is to send them a 1099 if you paid them $600 or more. So you do not have to 1099 them, which is good. As a general rule, sort of best practice is, if you are going to pay someone, have them fill out a W-9 so that you have all the information just in case. So let's pretend you hired this person to do something specific in, say, April for $245. And then like 4 months later, you were like, wow, they're great. And you hire them for another $400 project. all of a sudden the total in that same calendar year is more than 600. So you all of a sudden have a 1099 reporting requirement. So get those W-9s early. And then Matt says, is it a safe assumption vehicle expenses are like home office expenses, split in some explainable way? Great question, Matt. For personal vehicle, one thing you could do is like home office, where you save all the gas receipts and all the maintenance receipts and all of that, and then do that percentage approach, like we talked about for home office, right? That is one approach. The other approach is to use what the IRS calls their standard mileage rate. And if you do the standard mileage rate, you do not have to track all of those different expenses. All you have to track is your business miles driven, and then multiply that by the rate. And the rate is calculated to include gas, general maintenance of your car, smidge of insurance allocation, right? And since gas prices are going up, that's one reason why we saw it higher in 2022 compared to 2021. So my suggestion would be just track the miles and then take the percentage. I think it would be different if you had, maybe you purchased some sort of truck specifically to move large artworks around. Then we might think about making that only a business use truck so that we could deduct maybe all of it instead of just the mileage. Is that helpful? Okay, good. And Sarah says, is this quarterly or annual? I'm so sorry, Sarah, I didn't see when you typed that, so I have no idea what the right answer is. Are we talking about the business miles deduction, quarterly or annual? Oh, when you file it in general. As a general rule, annually. I think if you are going to owe more than $1,000 when you file your tax return, then the IRS or your tax preparer or TurboTax or Free Tax USA, whatever system you're using, they will say, hey, you owed more than $1,000 in taxes. Why don't you go ahead and start paying quarterly? But for many individuals, especially if they have a W-2 job on the side, it's almost easier to just ask your W-2 job to withhold a little bit extra. So let's pretend you said you had a job. I don't remember if you said where you worked, but it's a W-2 job, I'm pretty sure. And so you could go to your payroll or HR person and say, I'm going to have, say, $8,000 of additional income from my art business. Can we adjust my withholdings to cover that? And what they will do is withhold a little bit more from each paycheck so that essentially you are making those estimated tax payments. You're just doing it through the infrastructure of your W-2 job, which is a lot easier, frankly. Great questions. One more last question, my last pop quiz question. How long do you have to save those beautiful records you created? Victoria says 7 years. Victoria, you are brilliant. It is in fact 7 years. The statute of limitations runs for 6 years, plus the year in which the expense happened. Porter Johnny knows it as well. Excellent work. Deja says forever. Yes, they should be part of your archive, and you should put them together and add them to your retrospective so that future artists can study your business practices as well. But that might just be me. In general, 7 years is good. Longer if you want them for the archives. Thank you so much, everyone. Your questions were amazing. Your interaction was amazing. Thank you, as always, to IAC, Paige and Connie. I appreciate everything you do, and all the best with your taxes this year.
Thank you, Elaine. Thanks, everybody. And we will send you a link to the recording either later this week or the beginning of next week. Have a great evening. Thank you, Elaine.
You bet. Bye, folks.
Bye.